Good afternoon, ladies and gentlemen. We're going to go ahead and get started because we have a lot to cover today. I am Cindy Fornelli, the Executive Director of the Center for Audit Quality, and I'm pleased to welcome you to our panel on the auditor's reporting model. What will the future bring? And I think, as you will hear over the next hour and a half, that it's going to be a eventful future as we implement phase 2 of the new auditor's reporting model, which includes critical audit matters. So we have a great panel who will be joining us today, and so alphabetical order. I will start with Steve Glover, who is the Associate Dean at the Marriott School of Business at BYU. He's done quite a bit of research in the audit area and specifically has looked at critical audit matters as well as other key auditing issues. We also have Josh Jones, who's a partner of EY's Professional Practice Department, focusing on public company auditing issues. I think the most exciting thing on Josh's resume is that he was the first ever CAQ Professional Practice Fellow. So he was our inaugural fellow, so we were very pleased to have Josh join us in that capacity. He also serves on a number of CAQ task forces, including our Auditor's Reporting Model Task Force. Then immediately to my right is Jim Kaiser, who was sworn in as a PCAOB board member in March of this year. I can't believe it was March already, but we're going on several months now. And that's after having been at PwC for 38 years. So he was retired from there. And we're really excited to have Jim on the panel today because while he was at PwC, he was very instrumental in helping the firm implement the KCAMs, the international auditor's reporting matter that included key audit matters as opposed to the critical audit matters. So we'll talk a little bit about the difference between KCAMs and CCAMs. And then last but not least, we have Mike Santay, who is the partner in charge of auditing standards in the National Professional Standards Group of Grant Thornton. And Mike also serves as the chair of the AICPA's Auditing Standards Board, so he will bring us some good insights as well. I do want to let you all know that we are taping this session today, so in a few weeks it will be available on the CAQ's website, so you will have that to use for your classrooms, and you can share it with your colleagues, so just note that that will be occurring. So, Jim, I'm going to turn it over to you. I think first you have to share something with us, right?
So I have to provide my disclaimer, which I'm getting used to doing. The views I express today are my own and do not necessarily reflect the views of the board, individual board members, or the staff of the PCAOB.
Well done. Legal would be proud. Legal would be proud. So, but I do want to turn to you first and talk to us a little bit. I think the audience all knows that the PCAOB in 2017 adopted the new auditor's reporting model and that there's a phased implementation. So the first part of it has gone in already, but the critical audit matters, which I think is the meat of the new standard, is being phased in and it's going into effect next year for large accelerated filers. And so what I thought we could start with, Jim, if you don't mind, is briefly describing what the new standard requires. And I also should note to the audience, we are going to hold questions. I will leave plenty of time for questions at the end of the panel, so you will have time for that. So if you could just give us a quick overview.
Okay. So first, the new standard continues to maintain the pass-fail option, but has some significant changes to it. I think all of you were aware of what we just went through in terms of the year ends for 2017, where there was disclosure of audit tenure, the statement that the auditor is independent, adding the phrase where due to error or fraud when describing the auditor's responsibility were all added to the standards this year, as well as having the opinion first in the report. The section titled sections titled to guide readers of the report, as well as the report being addressed to shareholders or boards of directors or their equivalents. Phase 2 is around CAMs and critical audit matters as we know them here in the U.S., which we're going to dive into today pretty thoroughly. So,
excellent. Thank you for that. So let's dive in and talk first about educating audit committees and investors. So we hear a lot of talk at the PCAOB and the SEC, and frankly within the profession and in academia, about the expectations gap. And so I think as the new CCAMs go into effect, we all are thinking about what are audit committees' expectations, what are investors' expectations. I think we should spend some time as a profession thinking about that education, and then also we'll spend some time here on the panel. So Josh, I'm going to turn it over to you first and ask you, what do you think investors are expecting to see? When will users of the financial statements start seeing the CAMs being communicated? I skipped a page, didn't I?
No.
I did. I'm sorry about that. No, I didn't. When will we start to see that coming into effect? And what do you think people are expecting? Do you think people have realistic expectations as to what they're going to be seeing?
Yeah, so that's interesting questions. I think just the simple, the answer to the simple question, which is when, I guess, gets to, I think the answer is not too long now, actually, about a year from now. I think we'll see, large accelerated filers who have fiscal years ending on or after June 30th, 2019 will be the first wave of companies that have to provide critical audit matter disclosures in the audit reports, and then basically everybody else, except for a sliver of companies, investment companies, business development companies, emerging growth companies, or I guess business development companies actually have to include it as well, but investment companies, except for them, will not have to require disclosure of critical audit matters, but the rest of the companies will be providing it in 2020 for calendar year ends, at the end of 2020. And your question on what are they expecting, I think it's interesting. It'll be interesting to see as we go through. One of the reasons I think we'll talk a lot about today, a lot of firms' implementation efforts. I think I think investors are looking for more information about the audit and better understanding of what the auditor works on in the context of the audit. Heretofore, the audit report hasn't said a lot about the audit other than the conclusion around whether the financial statements reasonably reflect or materially reflect GAAP requirements of GAAP. And so understanding a little bit more about where the auditor spends their time and the key aspects of the audit, the real challenging areas of the audit. I think they're looking for some more information from us to help make the audit a little more digestible to them, as well as perhaps help guide them in their understanding of the financial statements as well.
So Jim, in the UK, we've had KCAMs since 2016, and in fact the FRC expanded the auditor's report in the UK in 2013, but the key audit matters have been around for at least a few years. So talk to us a little bit about what has been the experience with other regulators. I'm guessing that the PCAOB has consulted with some of their IFER fellow members, and then of course you have some experience seeing what KCAMs are, and if you could maybe expand upon some of the differences.
So I think the biggest thing that I've seen from the other regulators around the globe is the biggest difference is what a CAM said was performed in terms of the audit procedures, and the underlying work papers may not have reflected that, was the biggest observations that I've heard from some of the other regulators. I think one of the other things that evolved over time was materiality now seems to be pretty standard in terms of one of the CAMs around the world. We had a session at IFER in Ottawa in the spring, and that seemed to be the two major observations. I think over time, initially, first in the UK, there were awards given for CAMs the first few years. I don't think we'll give awards here in the U.S. in terms of...
Well, what was the criteria? The most creative KCAMs?
I think there's also been some evaluations done in the UK of the impact on share price after the issuance of the auditor's report, and seeing if there was any significant impact of the issuance of the audit report on share price. So there's been those sorts of things, but I think the biggest thing that's occurred is, one, more transparency and communication, better communication between the auditor and audit committees as well as investors, and more transparency, I think, is probably the biggest thing we've seen come out of Europe. And the two biggest things, like I said, from an inspection standpoint, were the gap initially, and the materiality seems to have been the most common CAM that seemed to have evolved over time.
What are the differences between the UK model and our model? Because there are differences, not just whether it's critical or key.
Well, let's just say the similarity is that both are written in English, and the difference is they're both written in English. So let me just review with you the definition of a CAM under PCAOB standards. Any matter arising from the audit of financial statements that was communicated or required to be communicated to the audit committee and that relates to the accounts or disclosures that are material to the financial statements and involved especially challenging, subjective, or complex auditor judgment. Seems pretty clear. Now, the KCAM is a little bit shorter, but I think is pretty much the same sort of definition in many respects. Key audit matters are those matters that, in the auditor's professional judgment, were of most significance in the audit of the financial statements of the current period. Key audit matters are selected from matters communicated with those charged with governance. Seem pretty similar to me. I think the other thing that's pretty important to note is that both are principles-based. So I think they're very, very similar in that regard. In our standards here, we have 6 objectives. The UK has 3. Our first 3 are the same, basically, and the others are involved in discussing more of the auditor's subjectivity. So they're kind of the similarities that I would say. You know, we focus on the additional 3 on the degree of auditor subjectivity, the nature, extent of the audit work required, and the evidence obtained. The international standards really don't get into that level of detail.
But of course, some of those items that you just mentioned are embedded in other standards of the PCAOB, so it makes sense that they would be referenced at least in the new auditor's report. So, Steve, I want to get you in on the conversation next, and I know that there's already been academic research done on KCAMs, and that, as a matter of fact, even though it hasn't been implemented in the U.S., there has been at least some academic study as to the CCAM. So if you could explain a little bit about the research that's gone on and what that research has found.
Thank you, Cindy. So I don't have any cool legal disclaimer, Jim. It could be because most people believe in my opinions or agree with them, but that may not be the reason. Actually, the most important thing I want to say today is just thank you to the CAQ, to Cindy and Margot for organizing the panels. It's really important to the Academy, so thank you to Jim and Josh and Mike for coming. It's important for research questions, and we go back, and it's important to be current in our classroom, so thank you, thank you. There has been academic research, and I'll probably stay at a very high level. It's interesting when we hear about why we're doing this. Most of the time you hear about the positive consequences. You know, it'll improve investor understanding, it'll improve or at least hold audit quality constant, improve reporting quality, improve governance. And one of the things the academics can do is say, yeah, but in certain situations might it have unintended consequences. So overall, I think we'd say the CAMs have the ability to inform investors, or at least draw attention, at least initially. And that's a good thing because it looks like they're reading the CAMs in the various studies, particularly the behavioral studies. But we're also starting to see unintended consequences, which I think are just they're interesting and worth monitoring. And I'll usually, when I say CAM, sometimes I'll cross over between KCAMs and CCAMs, and a lot of people have done research are in the room, so I apologize if I don't characterize your research in the same way that you would, or your research questions. But let me just kind of go through some of the research questions. So one research question people have looked at is, does it increase audit fees? So there's one paper that says maybe a slight increase, a couple of papers that say there's no impact on audit fees. What about the effect on management? So all of a sudden management has auditors reporting things. In one study, it was if the auditor has to report your strategy around hedge accounting, they find that if there's going to be a CAM, the management's sort of risk-seeking. They'd rather just speculate than have the auditors go through this hedge accounting disclosure. In another study, looking at what would happen if management had private information. So think about a behavioral study, and they're in a regime where they have to report more information. They found that the management would withhold some of that private information if it was going to go to the auditors and then be disclosed. What effect might it have on auditor behavior? And you could think about, well, now that we get to disclose some of these really critical, difficult audit matters, in one case, maybe it's investor beware, we put it in a CAM. So in one study they found auditors were more willing to accept sort of aggressive accounting treatment, maybe because it's out there and the investors can understand that around goodwill. A study looking at what if the audit committee is less involved in monitoring or oversight, and there is a CAM. Again, auditors more willing in the CAM setting than in the non-CAM setting to accept aggressive accounting estimates. Do the CAMs provide useful information to the market? So in the UK, we've had the ability to look at some of these things. So there have been a couple of studies. They generally don't find a lot of market reaction to the CAMs. And part of that might be it's not new information. There's been earnings announcements, other news sources, prior period management disclosures. One study, you might be familiar, you can do eye tracking studies where you can give people an audit report and then see what they do with the disclosures. And they found that CAMs did direct attention into the footnotes. But as you vary the number of CAMs, it directed attention in various levels. In other words, if there's only 1 or 2 CAMs, you only looked at 1 or 2 footnotes. If there are 3 or 4 CAMs, you looked at 3 or 4 footnotes. So the good news is it directs attention. The bad news maybe is it directs attention. In France, and Jim, the panel might know more about this, there are these justifications of assessments that are kind of a proxy for a CAM. And so we have multiple years of these things in France in that jurisdiction. And what that study said, they seem to be more symbolic than informative. There was some weak evidence of information to the market in the first year, but in multiple, as you look at multiple periods, there wasn't much reaction over time. In studies looking at users' perceptions, this is interesting. A CAM that was perceived, that was labeled by the academics as negative, meaning small changes to inputs to estimate could have big changes to the estimate. That seemed informative, and the users thought that increased their evaluation of the economic situation of the company. In other words, the auditors were aware of it, they did something about it, maybe that suggests things are better. When they changed that CAM to say it would require big changes in inputs to have changes in estimates, they didn't feel like that was informative at all. It seemed more like it was appeasement. There's a study looking at a CAM around uncertainty, measurement uncertainty, and it reduced the user's confidence in the financial statements. There's a study that says if you start adding more information that's technical in nature, what would it do to the readability of the audit report? So there's a finding that particularly for non-professional investors, and that's one of the general findings, non-professional investors have a hard time processing a CAM. So the CAM reduced the readability and indirectly audit quality. On the other hand, there's a study that says if you get into the detail of the procedures, so here was the CAM, here was the significant, critical, difficult issue, and then you're really detailed in what you did with your audit procedures, that increased the perceptions of audit quality. Auditors have expressed concern that CAMs could increase liability. And results are mixed, but generally there's no indication that they'll increase liability, and in some cases will decrease it. So if there's a CAM and then a misstatement, there is a perception that at least the auditors were there. Now, interestingly, if there's a CAM for multiple periods and then there's a misstatement, they sort of perceive more negligence because that seemed foreseeable. You've had that CAM there for multiple periods and then there's a misstatement. Similarly, what happens if you have a CAM for multiple periods and then you pull it off and then there's a misstatement? You're worse off in that case. So even though having it for multiple periods increases negligence perception by jurors, if you have it for multiple periods, take it out and then it's there. So you can start thinking about what the panelists will be in terms of, do we have a CAM, do we keep a CAM, what about auditor switches, and we can talk about some of those things. When the CAM disclosures describe audit procedures, so that, again, you know, these are just things we can do in a laboratory setting. So if you describe audit procedures, earlier we said that improved the perception of quality unless there's a misstatement. In that case, if you described all your procedures and you didn't catch it, it seems like there was some negligence. It seemed like it was foreseeable. You were there, you did procedures, you still didn't catch it. If we stay with juror research, if you put, like we said, you're in a difficult position. This is when we kind of mentioned about, do I keep it in? Do I pull it out? So as you start thinking, we'll come back to research questions around what will happen in the early years. Do you want to have a lot of CAMs? Because there's some evidence that from a legal liability, you get coverage if there were a misstatement in that area. On the other hand, once they're there, do you ever pull them out? So lots of research questions around those issues. So what I said, I think one of the advantages that we've had so far is the behavioral research can sort of say what might happen. And as we get more data, there'll be archival research that will say what is happening, at least from a market perception.
So yeah, it sounds like there's a rich, fertile ground for upcoming research once it goes into effect.
Well, yeah, so if you give academics more data, they get really excited. And so from our perspective, bring it on, and there'll be lots of great questions. So yeah, we're excited about that.
I found your remarks quite scary.
Yeah.
Listening to all the possibilities.
In terms of I know it's, what's interesting is sometimes I think you can do a thought experiment. Now, you do have to be careful, Mike, because we have to sort of weight these, right? So there aren't that many misstatements to start with. And so, you know, we can isolate and do that. But I think it's useful for people to say, what does the psychology say about potential unintended consequences? And they go into a laboratory and find it. Over time, we'll monitor if there's ways to address those unintended consequences, and there might be.
Yeah, I think the litigation question is one that remains open. It's something during the comment period, because the PCAOB studied this for quite a while before they adopted the new standard. There were several questions along the way about what this may or may not do to increase litigation. And I know the data that's coming out of the UK and the EU is insightful and instructive, and yet they have a totally different litigation environment that we do. So I know that is something that will be on the top of minds.
Right. I was going to say that, so in some ways, their experiment allows our experiment to probably have less uncertainty, right? Because the world didn't end when auditors started to disclose materiality and difficult auditor matters, you know, but it is a different setting here, and legal liability obviously is a different setting here.
So now I want us to turn to what I think is going to be the most perhaps interesting part of the panel, and that is the pilot activities of the firms. So I'm going to turn both to you, Josh, and you, Mike, to talk a little bit about what you are starting to see. So because Steve, you said that one of the studies was around fees. I don't know if in your pilot tests you will know, or your dry runs, whether you will find out about fees, but we do know or can extrapolate that the CAM requirement will amount to significant work, additional work by auditors as they approach the audit, as they think about the audit. And so because of that, many of the firms, many of the CAQ member firms, including both EY and Grant Thornton, have been doing both pilot tests and dry runs around CAMs with their large accelerated filers. And so what I'd like to do is ask both Josh and Mike to talk to us about how they're going about those dry runs, how many engagements are involved in your dry runs, and then what the national office's role is as you are looking at developing methodologies around the dry run. So Josh, I'll start with you, and then Mike, I'll come to you, and then later on we'll talk a little bit about some of the lessons learned and some of the challenges.
Yeah, absolutely. So, I mean, given some of, particularly I found it interesting you decided to finish with the discussion of liability, but there's, those, I think those mark some of the concerns, obviously. I think this, as everyone has heard, I mean, this is quite clearly the most fundamental change to auditor reporting in decades. The audit report's been used to basically saying the same thing for years, and so now the dynamic of having our audit teams kind of speak, more individually, directly to investors about things they see in the audit is a big deal, and it's intended to drive, lots of benefits to investors in terms of better understanding of the audit and better understanding perhaps of the company's financial statements. And so it's, it creates a number of challenges from a firm perspective to manage some of the challenges that Stephen mentioned. And maybe just before we get into the specifics of our specific dry run, just talk a little about some of the objectives we are trying to manage to make sure we kind of adopt it in a way that's sensitive to all of the pressures that are placed upon us, but also upon companies that we audit, as well as trying to make sure we achieve the benefits that the PCAOB intended and that investors have asked for. And so as we think about it, you kind of have first the challenges kind of at maybe the firm level, which is kind of how we adjust our system of quality control to manage this change. And that starts with obviously analyzing the PCAOB standard, thinking about changes to our methodology, to our guidance, to our enablement, as well as training to get our professionals kind of up to speed with what this new requirement is. As Steve said, the world hasn't ended around the world, but if you were to talk to some of our engagement teams, they think it just might when the first year they have to, the first year they have to put CAMs in their report. And so working through that and getting everybody sensitized from that perspective, at least at the firm level, is something quite challenging. And then you step back and you say, well, now we're going to have, in EY's case, over 1,000 audit reports that are all individual to each audit. Trying to make sure, each audit team is different, each situation is different. So trying to make sure we have a consistent way of thinking about critical audit matters and describing critical audit matters while at the same time recognizing each engagement is different, creates a lot of challenges to make sure we can do it in a way that's respectful of the standard. And so thinking about the review process internally, how we can manage that so we can, particularly in the early years, make sure we get, some consistent thinking and so forth, creates a lot of challenges given the size of the practice. And so that's something obviously trying to vet through in terms of the pilot testing and dry runs. And then I mentioned from an audit team perspective, this is a big change for them. They haven't had to think about the audit report other than the pass-fail conclusion for forever, except for some other minor situation, not minor, but isolated situations. And so now the audit report's probably going to need to be a more focal point of their audit process, more so during the year as opposed to something they do the last couple weeks of the audit. And so getting them sensitized to really thinking about that early on in the audit process and engaging with companies about that is going to be really important. And so going through these activities to learn how we can do that is something we're trying to accomplish. And then companies and audit committees are very concerned about this dynamic. This is the first time we'll be speaking about their financial statements in our audit report, and so they want to know, they're very interested in how they can prepare for the stuff that we might say and when they're going to see it and what we're going to say and what questions might come up. And so trying to get them involved in that process early on is really important. And so we actually started testing some of this stuff last year when the PCAOB approved the standard and did some pilot testing where we asked our teams to go through the process. We're lucky because, There has been the requirement for the key audit matters and the ISO requirements around the world, so we're able to leverage some of that learning, but really gave us some good insights as to how our teams are reacting to the requirements, and we extended that to having some discussions with management and audit committees as well, and so it gave us some good understanding of, how our teams are approaching it, how audit committees are approaching it, how clients are approaching it. This year, we're kind of stepping that up a little bit, I guess a lot. We're asking all of our large accelerated filer teams to go through that, so it's roughly 500 teams, and we're basically asking them to go through it, as if it would be a live fact pattern, so live as if it was an implementation. So in connection with their 2018 audits, we're having them start the process of identifying CAMs as part of the planning and interim kind of testing process, go through a process of drafting CAMs over the course of the summer and early fall, have it go through an internal review process, and then engage management and the audit committees later this year to kind of gauge their perspectives. And we're taking those lessons learned over the course of this year, and we're then going to quickly turn it around and then get it all squared away so that next year when they have to do it real time for real, we'll be hopefully as prepared as we possibly can. So.
Mike, what about at Grant Thornton? Are you having all of your accelerated filers go through a dry run?
Not everybody. No, we've got a bit of a scaled down version of what Josh described. The same objectives, to try and get the teams to start to think about this earlier, to inform our policy development and practice what we think the national office needs to do. And so we have, we've got a couple, like a two-pronged approach. We've got where we're doing what we'll call a deep dive with, say 10, 12 of our large accelerateds and doing what Josh said, having teams draft, share with the audit committees, that'll come later. And then we're doing just kind of what we're calling like CAM brainstormings with 30 to 40 other clients where we're, teams where we're just kind of having them sit and look back, what would you have drafted as CAM, walk through the standard with them. And it's been interesting as some of the teams in the offices have found out about that. I want to be part of that, So it's started a little bit of a awareness is getting developed. We spread it across the geographies and different industries so that we can have more touch points. But to have everybody draft, I think it'd be like that scene in the Miracle on 34th Street where they dump all the letters on the judge's office at the end.
I was thinking Carrie.
Carrie, okay.
That was what came to my mind.
But it's coming, right? Yeah. So we're starting a little bit at a slower pace, but same general approach and objectives as Josh outlined.
So let me ask you both this. How involved is the national office? I would think that this is going to be critical in order to get consistency across the engagement teams in approach, not in terms of the CAMs themselves, right? Because as you mentioned, Josh, it's going to be unique to each engagement. Right. But I would guess that these are being run out of national office.
Yeah, the national office is heavily involved. I think, a big part of it is trying to understand how, since it's such a new requirement, understanding how teams are going to react to the process of identifying CAMs and the process of describing CAMs and making sure what they say reflects reasonably kind of a nice summary of the really important aspects of the audit, right, that drove why the matter was a CAM is something it's different. And so we, from a national perspective, want to make sure we understand, quite frankly, whether the guidance we are enabling our teams to use, right, is having the right effect, understand how it's impacting them, understanding concerns that come out, and make sure we understand that and can help guide them through the process. So it's very much a learning process from our perspective, as well as to provide oversight to make sure that, we don't want to set expectations incorrectly with audit committees. We want to make sure, and management, so we want to make sure that, we're doing our best to make sure the process is well understood on their end, and our teams are delivering the right messages as well.
And Mike, is same national office,
same,
heavily involved? Yeah,
heavily involved. Cindy, I mean, and the point Josh made earlier about, this isn't something that you just start drafting at the end of the audit. Is going to be an important one to get awareness and socialize early. So, we've had, I mentioned like these brainstorming, the touch points with a number of teams. We have a national office, a regional person or an office risk management person sitting in on those because they're probably going to be first line on getting the questions. Hey, does this rise to the level of a CAM? How does this wording, as the teams start to move through this, so that, yeah, national office is heavily involved. So.
So I know when people were commenting on the proposal, this last round of proposals, one of the big issues of concern was, should the auditor be the original source of information? And so I think the PCAOB did a good job of explaining that that was not the expectation, that the auditor should not be the original source of information. But I'm curious, Josh, as you are going through your dry runs, are you seeing that as you work with the preparer community in the companies that you audit? Are they concerned that you might be the original source of information?
You know, we haven't seen a lot of that yet. I think for the most part, I think the clarifying changes that the PCAOB made to the final standard have helped, I think, reduce the opportunities where the auditor might be the original source of information. I think there were some of the changes that were made around really focusing on the execution of audit procedures as opposed to the maybe judgments around the design of audit procedures help kind of maintain the focus on matters that are more likely to have, you know, significance in the financial statements. Obviously, the matters themselves have to relate to accounts and disclosures, and so I think at this point, for the most part, we haven't seen lots of that. You know, that being said, there's still, you know, as we still go through, and we'll talk about this a bit later, we still go through, you know, questions that come up during the process around how do you think about things like significant deficiencies in the context of your CAM determination, and how does that, and I think the statements and the guidance and the PCAOB standard really help think through that, but you still get questions around how do you work your way through that process, and how ultimately would those matters influence kind of your judgments kind of more broadly, or the things that we're still, you know, kind of noodling on internally as well as throughout the profession, I think.
So Mike, another concern that we've heard from the regulatory community, including even the chairman of the SEC, is the concern that CAMs will be ineffective if over time they devolve into boilerplate or jargon. Obviously, you can't tell by your dry runs whether or not you're going to see boilerplate, but do you see jargon creeping in even now in your dry runs?
Yeah, and it is early in the process, like Josh said, but we have started to see some drafted CAMs where you know it's gotten a little bit overly technical. You know, rather than provide examples on this, because I know that's where the PCAOB landed as well, was to not, and Jim obviously could talk about that, but not provide examples so that the teams could kind of decide on themselves how to write these specific to their client, and that's I think been some of the international learning of this is supposed to be specific to your client. So we're working on a drafting framework. We've been trying to draw insights from some of the discussions we've had with the teams on how to draft things. Now that being said, will example CAMs there'll be a black market for those where they're amongst the teams, and they'll start to share, and
sell them
you know,
on
I've got a loan loss, and you know, so hey, how did you write yours? I mean, that's okay to have some sharing, but I think the key will be to have, you know, the partners involved in some of this drafting to really say, hey, it's okay to go specific on this, and to provide the insights that are needed to you know, specific to the client, to kind of avoid that notion of boilerplate. Will the topics be the same? Probably. You know, there'll be a lot of consistency among the topics within a certain, you know, client, but will it need to be described differently? That's what we're going to try and drive towards.
Well, and I think there might be some consistency in a particular segment or industry, right?
Yeah, clearly.
And you could anticipate, I don't know if you're seeing this in your dry runs yet or if you've got enough data, but you might anticipate that in oil and gas, you might have similar kinds of CAMs across the registrants in that industry.
Exactly, yeah.
Okay, Cindy, can I ask you a simple question about the dry run? So I would imagine.
I only ask questions.
I know. You can edit this out of the video, Cindy. I would speculate audit committees probably want fewer CAMs. So do you get into discussion about just the nature and extent? Like, are we trying to get the minimum number? Or from a liability standpoint, we want a lot of CAMs? Have you got into the extent, like the number of CAMs? Have those questions started to come up in the dry run?
Yeah, it's been interesting. You know, we had some engagement with audit committees as part of our pilot, and we're, you know, as Mike said, we're kind of still early days with our dry runs. But the discussions we have had, you know, audit committees and management are reticent around how CAMs are going to be used by by investors, right? They're concerned with what do they mean, what are investors going to take away from them relative to what they mean about the financial statements, maybe make judgments about the quality of the audit. And so there's lots of kind of concerns raised, and so there's lots of discussion going on around really what they're intended to do. You know, so, but at the same time, you know, we've had some teams come and say, well, we don't have any CAMs, and the audit committee says, well, you know, we do everything really well. We lay all these judgments out for you. We do a nice job analyzing things. How could anything be especially challenging? And so some of those discussions are motivated, I think, a little bit by concern, but also, I think, maybe a concern that CAMs mean that somehow, if it was hard to audit, they didn't do their job correctly, and that's not intended to be the lens either. And so there's a lot of kind of those conversations going on around, hey, this is really intended to focus on really the things where the auditor has to spend a lot of time, and certainly the strength of the controls has some influence on that, but it's really intended to be driven off of the complexities of the auditor's judgments as opposed to, you know, be a reflection on the quality of the company's controls. And so those are more of the discussions, you know, not as, you know, I think, and so it's been more focused on what types of matters are you thinking about being CAMs as opposed to, well, I want to have no more than one.
So at the CAQ symposium that we had on Sunday, we had a panel where we had an audit committee member who sits on 3 audit committees, and she was discussing, we had a conversation about critical audit matters, and her observation was that as she's going through dry runs with the firms that audit her 3 companies, that there wasn't a lot of surprise or discussion because these are the types of issues that the auditor is supposed to be having with the audit committee anyway under the required audit committee communication. So in her mind, there shouldn't be any critical audit matters that aren't already being discussed. Not to say that they're not CAMs, but that there should be no surprises because the standard is very explicit that the lens that you look through or the filter are those things that need to be discussed with the audit committee. So her observation and her conclusion was there should be no surprises because these are required communications anyway. Mike, are you finding that as you're going through your dry runs? And then Josh, the same question to you.
Yeah, I think some of our audit committee, and again, it's a little bit early, we've had probably a few teams start to have those discussions, and I think what has surfaced from that is there are some audit committees, for example, who like to hear everything about everything on the audit, and so you get a kitchen sink approach where the audit committee communication includes like auditor, you know, presentation on every estimate, as opposed to just critical ones and stuff like that. So some of the things that are flushing out of this is, you know, will it impact the communications? It might, and maybe that might be good because it will help with the focus on what are the critical audit matters. But to your point, Cindy, I think that what we've gotten back from teams and from a couple of audit committees we've talked to is that we should be talking about this at planning, right? Like Josh said earlier, it's like these are things we're going to, you know, we don't think we're going to be surprised by anything. Obviously, something could come up in an audit. You know, we don't know. It could, you know, per the definition, arising from the audit. So something could come up in midstream, but for the most part, we think that the teams, you know, like you said, no surprises. We pretty much know where the tougher areas, the especially challenging areas, are going to be at planning, and that's where those conversations will start with the audit committees.
Yeah, and just building on that, I think our experience has been very similar. I think the matters that have kind of passed through the process have not been surprises. There are areas where we're having lots of discussions with the audit committees today. So I think when we have had CAMs, you know, that discussion has been not too bad, at least thus far. I think the questions you get right after that are, okay, so, you know, when are you going to tell me these going forward? You know, who's going to review them? You know, what exactly are you going to have to say about those matters in the report, and how are they going to compare to my peers, right? And so it gets pretty quickly into that, you know, kind of almost not logistics, but those discussions around, okay, well, going forward, is this all I can ever expect? How might it change? And then, you know, how do I need to be thinking about this in the context of my financial reporting process, since they want to have plenty of time to prepare themselves for whatever might be in the audit report. So.
And what about conversations with management? How are they involved in this? And are their expectations different than the audit committees, or are they watching over your shoulders, worried about what the communications are you're going to have with the audit committee, or are they pretty in tune and no surprises for them either?
I mean, I think from our perspective, they're very similar. It's, I think, just wanting to understand what it is that, I mean, I think there's some concerns similarly around how they're going to be used by investors, but I think just, again, understanding kind of what those matters might be, how what we're going to say might relate to what those disclosures look like in the financial statements, and how can they best put themselves in a position to understand kind of what those matters might be and start anticipating the questions they may get from stakeholders as they go through it, because I think they're expecting, because there'll be much more information, perhaps investors may call with questions. How do you think through that stuff and things like that? And so we've seen engagement of investor relations and general counsel's office through the dry runs to really make sure it's not just the controller and CFO who are well-versed in this process. Other disciplines within the organization have really wanted to understand this to help gauge the impact. So.
That came up in the symposium as well, is that companies, I think, should anticipate that there could be questions of the investor relations groups within the company from investors, and who is going to answer those questions and how those questions would get fielded. And the CAQ put out a resource, which is on your chairs, that flags some of the key issues with respect to CAMs on these early stages. But we have a placeholder in there that we should anticipate questions, but I think it would behoove all of us to think more about, from a company perspective, where those questions could go and who's going to be responsible for answering those questions. I don't have an answer to that, but it seems like it could be something that we should all consider maybe a little more deeply. Jim, I want to ask you, going back to the boilerplate question, I don't know if you've had an opportunity to look at what's happened in the UK, but have you seen boilerplate evolve? I know when the UK first implemented the KCAMs, and there was a lot of excitement over some particular auditors' reports because of the unique language that they used. Some of the language was maybe flowery, and which I don't anticipate that we will see here in the United States necessarily. But have you had an opportunity to look and see if it has devolved into more boilerplate? And also, Steve, to you, is that something that academics have started looking at?
So I think over time, and going back to what you talked about here, this is the biggest theme of the discussion, in my mind, is change management. Change management for the auditor in terms of when they're working through issues, not only do they think about, well, do we need to talk about the audit committee about that? Does it need to be considered a CAM? Change management in terms of discussions with management throughout the process, and when that might come into the discussion of, is this a CAM? Change management, the systems of quality controls in the firms in terms of their reviews of auditor reports, which is different than it has been in the past. So that's the biggest theme. And I know from a more an international standard than just the UK, change management was the biggest thing they went through, and I think you saw firms' approach evolve a bit over time. Some was more boilerplate initially and evolved. Some was very individualistic, I would describe it as. I think there's been examples that many of us have heard about that have evolved to be more what was intended, less boilerplate, easier to understand, and really focused so that an investor can understand the true impact in plain English, depending on what version of English you're using. But that's, I think, the biggest thing that I've seen evolve, and what some of the other standard setters talked about at this meeting in Ottawa is that they've seen it become more routine, that the auditor was really focusing on the main things that needed to be communicated, and that also the consistency around industries. Whether the banking industry, oil and gas, pharmaceuticals, you began to see consistency evolve over time, and that if you were in a certain industry, you would be expecting to see certain CAMs, and it was more an exception if they weren't there than if they were there.
So, yeah, not surprisingly, in year one, there were differences, and we are expecting those differences to go. I think, so boilerplate's one concern is just, is there going to be information content? Like we said, there is a concern that it could represent almost a disclaimer of responsibility. We put it out, here's what we do. And so I think from an academic standpoint, the concerns are more about the unintended consequences. Does it encourage risk-seeking behavior either by management or by auditors? I think there's a concern that as we get, Mike says we're going to get technical because we want to explain how it is. What does that do to a non-professional investor? If they have a hard time processing a standard CAM, if it's a more detailed, does it really close the gap? And I think over time, if they do become more consistent, which we expect they will, and we don't see a market reaction or benefit, then I think the monitoring and the assessment of effectiveness over time will say, are the benefits exceeding the costs? Are we getting something out of it, particularly if there's any unintended consequences around liability or communication or auditor quality or responsibility. So I think that's kind of what the academics will be interested in is, as we turn these dials, what are the impacts?
So Mike, Steve just mentioned risks, and so can we dive down a little deeper into that? Are all audit risks critical audit matters? Where's that tension point between significant audit risks and critical audit matters?
Yeah, it's a really good question, and I think the PCAOB acknowledged there would be that discussion perhaps in the release document. This notion of, okay, I've got significant risks, how could that not be a critical audit matter, right? So we've had that discussions with teams. I'm guessing most of the firms doing pilot testing are having that discussion, and what we've made clear is it's not a one-to-one, right? You could have a significant risk, and I think everybody starts to think about the fraud standard and the de facto risks there with management override and revenue, and maybe it is a significant risk from because I have this fraud risk, but was it especially challenging to audit revenue? It might not be. So there could be some differences there, Cindy. It's not a one-to-one. I think the more of a challenge will be to get to the end of the audit and say, okay, I had a significant risk around a very a complicated acquisition with a lot of judgments, and to not call that a critical audit matter, that might leave someone thinking, boy, are you sure about that? So I think those have been some of the discussions with the team, so definitely not a one-to-one, but I think once you get outside the de facto significant risk, there's going to be more of an inclination to say those are probably critical audit matters.
Josh, what about the relationship between critical accounting estimates and critical audit matters?
Yeah, I think it's somewhat pretty similar to some of the observations that Mike mentioned with significant risks. I think when we've looked at the CAMs that our teams identified, I think in a lot of cases there's kind of good correlation between those and critical accounting estimates. What we have found interesting so far is that not all critical accounting estimates disclosed by a company have made it through the filters by our teams to call them CAMs. And we've tried to kind of peel that back a little bit and are still kind of working through that internally. But I think as we've seen, in a number of situations, you start looking at some of the critical accounting estimates that are included in the company's financial reports or in MD&A, you start to wonder, well, are those really the most, kind of significant areas of judgment, and are those estimates really that sensitive to changes in assumptions as what was intended by the SEC under its rules? And I think, you've heard discussions around, how, maybe there's more disclosures today than they're necessary to comply with the SEC's rules. So we're seeing a little bit of situations where when we stare at those critical accounting estimates, we say, oh, that maybe those weren't especially challenging due to either materiality or other factors, but yet, they were called critical accounting estimates in the financial statements or in the document. And so it it's still something we're working through. We haven't really had any discussions yet with companies where we get a sense that they may be concerned about that maybe lack of direct correlation. I know there were some concerns by stakeholders that basically the CAMs would just be a regurgitation of the critical accounting estimate kind of disclosures, but we clearly haven't seen that. And what we have seen, like I said, in some cases is where there are a few that are left on the cutting room floor that were disclosed as such. So.
Josh, earlier you mentioned significant deficiencies. How does those play into an assessment of a critical audit matter? And I think the PCAOB standard, actually, and the guidance around that addresses that issue. So maybe, Jim, we could start with that if you wanted to mention what that is, or Josh, you can just dive right in and talk about how you're viewing significant deficiencies vis-a-vis CAMs.
I'm happy to start, and Jim can tell me if I'm wrong or not, so, since it's his standard, or the board standard. But, I mean, I think the PCAOB standard basically says, a CAM has to relate to a material account or disclosure in the financial statements, and a significant deficiency, doesn't necessarily, while it may relate to, it's not a disclosable event in and of itself. So the determination that you have a significant deficiency in it by itself doesn't, that itself cannot be a CAM. And what it does, though, say is that I guess, some of the challenges presented by the significant deficiency could be amongst one of the factors that could cause a matter to be a CAM. And I think that's really, the notion that, I think a significant deficiency by itself, couldn't be a CAM, I think makes a lot of sense, just that determination. I think some of the challenges we're running into, or not running into, but kind of noodling on is really, okay, so once you take that off the table, how do you think through the ramifications of a significant control matter when you're thinking through the complexity and the other factors around what makes a matter a CAM? And how do you think about that in the context of original information and some of those other factors? And the release does provide help that, you certainly can describe, some of those matters without using the word significant deficiency. There's ways to convey some complexity within the organization that might either be apparent through the filing or might not, but we don't have to necessarily use those trigger words. But I think just working through the complexities of how you might do that in a way that that adequately describes the CAM and the matters that caused it to be important, without necessarily causing investors or causing companies to be in a position where they feel compelled to describe it, maybe more specifically, is something we're working through and trying to figure out the best way to do that. I don't know, did I describe that okay?
I think you're right on. In terms of, you don't necessarily, it's not a material weakness, it's a significant deficiency, and there's requirements, different disclosure requirements around significant deficiency versus a material weakness. And you've got to articulate, maybe there's more audit effort required because of that significant deficiency, so that you would explain it in that fashion, yes, than saying that there's a significant control deficiency in that regard.
Mike, you earlier made reference to good CAMs and bad CAMs. I think there might be a perception amongst some that a critical audit matter is inherently bad, and yet I don't think that's what the PCAOB intended. It intended there be discussion about these critical audit matters. Are you seeing that in your dry runs, that there's this notion that a CAM is inherently bad?
You know what, not so much coming out of the CAMs being identified, but some of our discussions with the teams. This notion that if we call something out, is somebody going to view it negatively? And I think that's going to be an important, as we move through this process of investor, awareness and touch points on what CAMs actually are. I mean, it's something that was especially challenging for the auditor, and that may or may not show up as key item in a press release or something like that. But it is something that the auditor maybe have been well aware of, right? That yes, going in, like I mentioned in planning, we know this is going to be an especially challenging area, and so it's likely going to end up as a CAM. And so I think how we write those is going to be important for the audit firms to think about, to kind of not to differentiate, but to be clear that this was an area that we got it. We were ready for this, and not just we, the client was ready. We had a good client who was on top of things and provided had good evidence for us, and so that may be a little nuanced and maybe a little tricky without getting jargony, so I think that's going to be a challenge for the firms, but I think it's going to be an important, really important aspect of this whole process to say that this was, yes, it was a challenging area, but is this something is this a red flag or a yellow flag that's gone up because it's a CAM? And I think that certainly wasn't, as you said, I don't believe it was the intent, and certainly, hopefully, won't be viewed that way as stakeholders and investor analysts read these documents, or read the reports.
So Jim, we've spent a good amount of time hearing from Josh and Mike about some of the anticipated challenges that the firms will have as they go to implement the new critical audit matter piece of the auditor's reporting model. Are there any perspectives that you can share on some of the anticipated challenges that the PCAOB has identified?
So it's early days. One of the things that Chairman Dunkey has done is asked various members of the board, based upon their background, to be champions working with the various divisions. And I'm working with inspections, with board member Desparte, and the chief auditors group. And in that regard, I'm working with both groups and also with board member Brown on this issue. We're working on what's our implementation plan right now, what additional guidance we might need to give, say this time next year. We're looking at the firm's plans around this right now as we go through our reviews of quality control. So early days. We want to make sure we understand implementation issues as they arise and have dialogues around them. We'll probably have discussions with the SEC, because the SEC looks at far more audit opinions than we do in the course of their responsibility. So there will probably need to be some dialogue and back and forth and protocols established in that regard also. And our plan is to kind of, over the next couple of weeks, get our internal plan together and begin to have discussions with the SEC and the staff over the fall, kind of the implementation plans and how we might coordinate and develop protocols with them also.
And what about post-implementation review? We've heard, I think, Chairman Dunkey, Chairman Clayton talk about the need for post-implementation review, and I do appreciate that it's early days and you're just now, as you said, developing your implementation plans, but when might we expect that? What do you think that will entail? Can you give us any flavor?
So we will do a post-implementation review after the standards are implemented, obviously. As Chairman Clayton had said, we would. The intent also is to look at an interim plan, post-implementation review between the two effective dates. We've had some preliminary discussions on that, but we will have an interim implementation review done between the 19 effective date and the 20 effective date.
And then you mentioned that one of the areas that you're stacked up against is inspections, and so I can't let you go without at least probing you a little bit on what the plan is for the inspection teams. How is the PCAOB training the inspections teams to look at this? Can we expect that we might see inspection deficiencies, or will there be a bit of a grace period as you do your interim implementation and post-implementation review? I know that you are a regulator, and so you can't give us too much, but anything you can share on the inspections front?
Early days, consistent, but I think that's just what we're working through. I think the biggest learning that I've heard coming from the European regulators was the gap between what the CAM said, the KCAM said, and what the underlying work papers reflected was obviously one of the big learnings that we've heard to date from our colleagues around the world. So obviously that's important to keep focus on from an implementation standpoint. Let's be honest, we begin our inspections in arrears. So the first implementation date is June of next year, which means those 10Ks don't get filed until August. So where's that in our inspection cycle? You're probably getting towards the end of it. May we have some focus areas or some focused inspections on some of those early companies adopting next year? It's very possible. But the big brunt of it will occur in our inspections the following year. So stay tuned. I think we understand the interest from all our stakeholders. We want to make sure that we give the right feedback and implementation and deal with both the implementation issues and inspections appropriately. So stay tuned, I would say.
Maybe the CAQ and the profession can persuade the PCAOB to do dry runs on inspections. We've had a lot of discussion, and so Steve, I'm going to go back to you and ask you two questions. One is about what you would recommend to the audience as undergraduate students when those entering the profession now graduate. CAM's critical audit matters will be, CCAM's critical audit matters will be around for a while. They'll be fully implemented. Is there any advice that you would give to academics who are teaching accounting and auditing to their students about what they might focus on now? And then I also want to pick your brain a little bit about, are there any key academic areas for research?
Excellent. Yeah. My experience is if you bring up these issues with your students and let them read maybe some of the discussion or comment letters and let them think about what might the effects be, what might the concerns be, they'll actually have a very good discussion and they'll come up with a lot of the issues, which is rewarding for them because then you can say, wow, that's great thinking. And so I would encourage you to say, look, this is the biggest change in decades. What do you think might the concerns of the audit committee, management, the auditors be? And I think they'll surprise you. They'll do better than you think. And then it'll allow you to move down that path. I think I'll say what the other panelists would say is it's another indication that it's important, it's relevant. There's a lot of attention on what the auditors are doing, what they're reporting. So I think that bodes well for those who are interested in going into the profession. There are things that are changing, and that's, I think, exciting. On the future of research, as we think about some of the topics we've had, even this one that I hadn't thought about was what will happen at the interplay between CAMs and inspections. Anytime there's more data, I think, like I said, the academics get really quite interested and excited. CAMS with a C has been largely a behavioral setting because we haven't had the data, but as the data comes out, we'll have more archival field studies, survey data. Some of these studies that go in and analyze words in terms of the meaning of words, word count, I think as they look at the CAMs, and the firms may not like this, but early on there'll be differences across firms and even how they deal with industries. Do those have indications around reporting quality, audit quality, indicators of misstatements? What will happen over multiple periods? Will they start to converge? I think around auditor switching, that'll be interesting. Do some CAMs drop off? Does that suggest firms have different views or policies around CAMs, or is it more industry driven? Will we start seeing, like we talked about, boilerplate or long lists? So what's kind of the behavior in what gets reported? There may be unintended consequences. I think academics, we can point those out. I think we also have a responsibility to say, where do they sit economically? And what could we do to overcome that? So do we have ways that the CAMs can be adjusted to address the potential unintended consequences. We might think about other disclosures that aren't coming out that would be important as we look across different jurisdictions. And then one that we may see down the road is, when would you remove a CAM? Is there guidance around, looks like it's time to remove, or what would you say, about that, and when do you put it back on? And so how sticky will they be? They'll probably be pretty sticky. So those are just some ideas, and this audience will come up with lots. Like you saw, it was what I found interesting. I hadn't looked at all this literature. Lots of interesting questions have already been addressed, so there's lots of moving parts here.
So Jim, are there any areas of research that the PCAOB has identified that you would like answers to?
What he said. But I think in the adopting release, there was a lot of discussion about the economic considerations, the costs, benefits, and as Steve said, the unintended consequences. I think that's at least my initial thoughts around it. I think when you delve down into details of correlation between number and content of CAMs, is there any indicator of audit quality? More CAMs, more audit quality; less CAMs, less audit quality; more CAMs, more boilerplate; less CAMs, more plain English that people can understand. It's, as I said, I think the experience that has been seen internationally, this will evolve over time. There was, seems to be a more consistent approach to it over the last several years. Like I said, materiality, I think that's very important. I think the way you describe materiality is very important, so that a reader really understands what materiality means to the auditor, because materiality to me might mean something different to my other three panelists here. And describing it that way, I think, is important. So the materiality concept, I think, is always one that's really good for research, and you're going to have a lot more data now for that. So I know from an investor standpoint, that's a very hot topic with them. So there are just some preliminary thoughts that I have on what we might do. And if you don't mind, could I take a few moments for a bit of a commercial?
Oh, please.
Okay.
I think the audience would love to hear a commercial from you.
So first, those of you who participated in the survey process we had for our strategy this spring, thank you. We got a lot of excellent feedback from our various stakeholders. And this week, I anticipate that the board will approve the preliminary strategy plan, which we will then publish and then have for open comment for a 30-day period. So I would ask that once that is available on our website, which I think I believe will probably be by the end of the week, that you read the draft strategy plan and please provide us your feedback over the comment period.
Any chance we could persuade you to extend the comment period to at least 60 days? It is summer vacation and all.
The issue you have with that is our statutory date in terms of when we have to provide it to the SEC. So
that'd be a big fat no?
yeah.
That's what I'm hearing, Jim.
If something comes in at 30 days in 1 minute,
Well, thank you for that. I do think that's very important, and I would very much encourage everybody to look at the draft strategic plan, and despite the short comment period, to make sure that you do comment on it. I think that as a former regulator, regulators like to hear from a wide variety of stakeholders and constituents, and I think this board in particular has made that a focus and a theme of what's going to be this board's approach to standard setting and setting their strategic plan, is listening to a wide range of stakeholders, and they can't do that unless we're willing to get engaged. So I would encourage you to take a look at that and comment to the extent that you can. And I think I can say that you don't need extensive comments necessarily, just directional is fine, or high-level comments, but just let them hear from you.
I think we've listened to the feedback we've gotten.
Yeah.
And we've
So-
tried to reflect that in the plan.
So the letter might just be, thanks for listening to us. We like your approach. So we are at that point of our session where we're going to take questions from the audience. I would ask that you raise your hand, and when you get a microphone, please ask your question, and we will do our best to answer.
All right. Well, thank you for your comments. First, let me say that I'm not an attorney, but I am a devil's advocate. All right. And one thing I heard, which was kind of disturbing to a certain extent, and you can comment on this is mostly for Mike and Josh. So, you know, I assume some of these CAMs are going to come out right in the audit planning meeting. I mean, before you even start the audit, because this will help drive the audit. And what I'm concerned about is through time, these CAMs will, maybe some new ones will come up. But what I heard that disturbed me was these dry runs with the audit committee. So when you're the defendant in a lawsuit and the prosecuting attorney says to you, did you change the number of CAMs after you met with the audit committee? And did you change the wording of your CAMs after you met with the audit committee? What would your answers be?
You want me to try that one?
You want to try that one?
Yeah, so it's an interesting, one of the questions that have come up kind of very, along those exact lines are, you know, some of our teams have, you know, the purpose from our dry run perspective and the way, you know, we've thought sequencing makes sense is to give companies and audit committees the opportunity to prepare themselves for what the reports might say. And then, you know, quite selfishly, because of the reviews we're doing internally, we need to do some of this determination earlier in the year with some follow-up procedures later in the year to make sure it's current based on the totality of the audit, right? So there's an element. But one of the questions we get is, well, what if the company doesn't like the CAMs we've identified, right? And, you know, I think, you know, what if we get comments from them about the types of things we need to say? Do we should expect comments from them on wording comments and everything else? And I think the message we have internally is this is an audit requirement. This is our auditor's report. So we need to make sure we do our best to comply with the PCAOB standard through that process. So we have to be in a position to defend our judgments for CAMs at any level, right, through the course of, you know, as a result of the audit, right? And so that's how we're, you know, that's how our methodology and our training is geared toward. This is, while certainly this is something that's sensitive to our clients and to the audit committees, it's something that we have to defend ourselves to stakeholders and to the PCAOB and our inspection teams that we've complied with their standards. So that's, you know, that's how we've managed it thus far internally. I don't know, Mike, about.
Yeah, I think, and then part of, and this was a question earlier when Cindy asked about is national office involved, because when those situations arise, I can see that rising to the level of a consultation. You know, the national office, you know, risk management folks are typically involved in those, it would be involved in discussions we have today, for example, on, you know, if we have a material weakness that we think we've identified, or if we have a going concern situation. So, you know, those do get to be contentious discussions sometimes with management. We may have that with a CAM identified, and so I think that will play out through the firm's quality control and consultation process, I think.
Question here in front.
First, just a comment to Steve. When the British first came out with their CAMs, and I was looking through a number of them for the first 2 or 3 years, and I noticed that in some cases there had been a change in auditor from the first year to the second year, the second to third. And one of the things that I noticed was that the new auditors had materiality that was apparently, based on the way that things were written and my interpretation of them, that the new auditor's materiality was twice as great as the preceding auditors were. And so I think that changes in auditors and how CAMs are treated would be an excellent research project over time.
You know, one thing that's interesting about materiality, those in this room sort of get it. You know, we tend to think of, well, we hope that investors would see that change in a certain way. In other words, if materiality is bigger, what would that signal? some research around material would say that seems good, more is better. So one of the things we have is an issue with translating the way we think about audit, even audit risk and materiality. So you would tend to think if you're going to increase materiality, that lowers effort, changes the scope. Investors have a hard time processing. So do we have to actually have little discussions, little vignettes about instructing people? Here's what materiality is, here's what the impact on the audit is, and here's what the change was. So when we get to plain English, it might have to be so plain that to us it seems unnecessary, but investors, particularly non-professional investors, but even professional investors, we're finding have a hard time processing and interpreting even materiality. But I agree with you, the switches and the changes will be really interesting.
And then I have a question for Josh, and depending upon his answer, possibly some follow-up questions.
Well, we're going to give you one more question. We'll give you one more question, and then we've got other people who have questions. But ask your second question, please.
Have you completed the process for the dry run or the pilot tests in any situations?
Yeah, we completed pilot tests in 2017, so we did get a fair number of teams go through the process in 2017. We have not had, I don't think any teams complete the process here in 2018 yet.
So if you completed them, how many cams were there and how long were they?
Yeah, so has been interesting. We saw, our pilot, we saw somewhere around an average of two to three cams per report, which was interestingly enough lower than what we've seen on average globally with respect to the key audit matter requirements, where I think we saw somewhere between around four plus 4 or 5 cams in those reports. And so we found that interesting, and we're trying now to go through efforts to think about, well, what might be driving those distinctions, and is there something about how, going back to Jim, your comparison of the definitions, while they seem very similar, or is there something about how we've interpreted the PCAOB standards that might be kind of elevating kind of their significance to maybe perhaps a level higher than what key audit matters evokes internationally? And then I do think there are probably some aspects of the definition that are different that might drive certain things as key audit matters that may not be critical audit matters. We've seen things like multi-location strategy determinations be things disclosed in some frequency in key audit matter disclosures, whereas I don't necessarily think that would neatly align with a critical audit matter disclosure here in the U.S. So there are some differences from that perspective, but we're still kind of early stages of analyzing the differences and thinking about what those might mean as we move forward.
Okay, so we have a question in the middle, and then there's a question in the way back too. Yes,
okay,
please, ma'am.
Let me first introduce myself. My name is Hiba Badawi. I am an assistant professor in Alexandria University in Egypt, Japan University in Science and Technology in Egypt. Actually, I thank you so much for this session. It's really an interesting point that needs a lot of research, especially with the changes that is undergoing for the audit report. The first question is that I am already preparing a research paper trying to investigate the impact of having an additional paragraph showing a critical audit manner in case we have a fair value estimates, and in this case it is of a third level, and so we have a high level of uncertainty on the investor's decision and their confidence in taking investments. Actually, the results were surprising, because I found that there is no significant changes between the two groups, although we are expecting more transparency after having additional paragraph and showing more information about the auditor's procedures. Does this mean that investors also need to be trained about this new audit format? This is number one. And number two, which is the question regarding this session. What are your expectations regarding the audit reports in the futures? Are we going to move away from the standardized audit report? Now we are adding one paragraph, and still we have more matters to be added. Okay, we are only having sample or examples of the key audit matters in the standard However, as the business environment is changing, we are expecting more and more to change in the audit report in order to provide the investors with the relevant information to take the resource allocation decisions. So what are your expectations regarding the audit report in the future? Thank you.
Well, I'll start.
Okay.
I think that while we all embrace the change to the auditor's report, I think maybe the next step might be management's disclosures. I think some of the key risks that companies play or companies face play into this as well. And so management's discussion and analysis, for instance, hasn't changed in many, many years. And so I do think that it might behoove the SEC to look also at management's disclosures as well as the audit committee disclosures. Several years ago, the SEC put out the concept release about what audit committees might disclose. And so, you know, the audit report is just one piece of the financial reporting process. And so maybe the next step isn't to look at the next iteration of the auditor's report, but to look at management's disclosures and audit committee's disclosures.
I agree with Cindy. I think the first question that you asked also was about investor awareness, investor training. I think that's what we talked about is going to be a big aspect of this, and I think that's one of the things that we're hoping that these pilot exercises will do is to help inform, you know, both PCAOB, any guidance, as Jim mentioned, that they're going to be looking to issue, or CAQ, like you guys have a brochure there, more to come on that, because I think investors are going to be possibly confused as to why there's this audit matter here, paragraph, talking about something that management really didn't address in a lot of detail outside of their footnotes, for example. So why isn't it in the press release, or why isn't it in their MD&A? So maybe there is overlap, but maybe not, and so I think there's going to be some definite investor awareness, education opportunities here.
Actually, this is what I have seen from their from these results, that investors might be afraid that this critical audit matter might be something like a modified audit report. So we can be more conservative, stay away from this investment. This is not the case. Right. So also, besides auditors might be trained for this new audit format, also we might expect also investors that need some information about this new audit report.
Yeah, no question. I think academics can play a role. I mean, as we think about, you know, maybe that's an unintended consequence. The question is, can we come up with a simple Q intervention training? What sorts of things can we do to address those sorts of reactions? Is it a matter of simply explaining it in another setting? So I think we can dive in to say, how can we help the information get conveyed in a more effective way?
And I would say, just from our investment advisor group, it's one of the things that is on our agenda as we move into the implementation period, is having a dialogue with the investors to make sure we're doing what we need to do from a communication and implementation standpoint with the investment community.
Yeah, I think that's important. Investors are so hard to reach because they're not monolithic. And so, but it is an important point, because this is who this is for, is investors, and so helping them understand how to use them. We have time for one more question, as long as it's quick, please.
Absolutely, I'll make it quick. This is Parveen Gupta from Lehigh University, and this is the question from my friend Josh. So Josh, I'm wondering about one thing. He knows me very well. I was at a session earlier, and the session was titled, "Is Corporate Reporting Fit for Purpose?" Very interesting discussion occurred there, and obviously one of the issues that was debated and discussed was, when we talk about corporate reporting, is it corporate financial reporting plus corporate non-financial reporting, and purpose, is it investors plus the stakeholders? So I guess my question is motivated from that discussion. In the CAMs, are we going to see, or is there a possibility of any CAMs that may be stakeholder related, rather than only investor? Because what I'm hearing here is only focus on the investor. So as you know, Josh, your community is implementing it, what are you seeing, and what is the possibility to see in the future? Simple question.
Yeah.
But the answer isn't simple, though.
Yeah, exactly. I mean, it's interesting. I do think, you know, I mean, you heard a lot, you know, the focus of the implementation now is making sure, we accomplish the objectives of the PCAOB standard, which is really providing, I think further insights into the audit, as well as, hopefully further insights to guide investors in their analysis of the financial statements. I do think you think about stakeholders, you think about, obviously management, the audit committee and others, and I think we're also challenging, are there ways can the process of determining CAMs really help facilitate, additional discussions about audit quality with management and the audit committee through that process? So the process of articulating why something is especially challenging, what's driving that, and really how the audit response is driven, and what are the key aspects of the audit response, again, aren't necessarily things that should be foreign to the audit committees today, but certainly, using this as an opportunity to put a finer point on what otherwise are pretty complex matters and how the audit approach deals with them is something that we're hoping comes out of this process as well to help them kind of make, see some further value out of the process. And then over time, again, one of the reasons why the process is sequenced the way it is to allow companies the ability to understand what's going on. And I know the PCAOB contemplated that perhaps CAMs might drive enhancements to financial reporting itself. And so it'll be interesting to see, I guess, whether, that discussion does drive some additional kind of reflection on companies around their disclosures going forward. So that'll be something more to come, I guess.
My very good friend, Mike, do you have something to add?
No, I was actually going in a different direction. So is that all right, real quick?
Please, yes.
Jim did a commercial. I was just going to do a commercial for private company audit setting. The Auditing Standards Board had exposed a proposed reporting models change, reporting standard last year. We just discussed it at the last board meeting. Steve was involved in the exposure drafts. If you think it's harebrained, you can talk to him about it. But it aligns more with the IAASB model as we've been doing convergence. So we are looking to vote out a new auditor report for private companies early next year. And it does include a standard on reporting on key audit matters, CAMs right now, but it would be optional. But we felt like we needed something in the standard on that because we do think this is going to drive interest not just in the public realm, but also possibly private companies, public interest entities, that type of thing. So we have that on the table for discussion. So thanks, Cindy, for letting me say.
You're welcome. So I will give a commercial too, in that after the firms finish their dry runs, the CAQ is going to compile lessons learned and other information from the dry runs, and we will issue another publication that will be publicly available talking about some of the issues that we flagged here, but having a little more data and evidence in the coming months. So with that, I would ask that you please join me in thanking Mike, Steve, Josh, and Jim.
Thanks for doing that. I was thinking
And thanks to all of you, not only for being here at the session, but all that you do for the future auditors.